start with Ray Dalio. Horrible month so far, but this could be an interesting bet.
Really tough month. Remember back in January, he had told CNBC that cash is trash. He didn't change his positioning. But now we have seen that he's been betting more against certain European stocks, France, Italy, Spain, Germany. France, where they're talking about potentially even nationalizing some of these companies. We can't assume that this is a one-way bet against the market necessarily. He may be hedging some positions, but we've seen him do this before back in 2018, where he took some big bets against individual German companies.
Well, fair. Many say that if there's going to be a global recession, Europe was already really struggling to grow anyway, so that's going to be sort of double whammy for them.
Hey, what's up, guys? Ray Dalio, one of the most respected hedge fund managers in the world, is betting big against European stocks. In this video, we will take a closer look at Ray Dalio's $14 billion bet against European countries, and then he will express his opinion about this upcoming global recession. Ray Dalio runs one of the biggest hedge funds in the world. Recently, he placed a big bet against stocks in European countries such as Italy, Germany, France, Spain, and so on. Dalio opened $715 million short position on ASML Holding, which is a Dutch company and currently the largest supplier in the world for semiconductors industry. At this time, it makes a lot of sense to betting against suppliers, since most of the supplier company, especially in Europe, are shut down due to this current worldwide pandemic. In the United States, stock market dropped by close to 30% within just a matter of 4 weeks. It was one of the steepest drops in the market history. In addition to that, we had number of daily double-digit losses. The last time we have seen something similar, it was in 1987 Black Monday, when stock market dropped by close to 20% in one single day. Ray Dalio's Bridgewater's Pure Alpha Fund isn't shining, at least not yet, as it was in 2008 housing bubble. Currently, they are also down by 20% since the beginning of this year. To offset some of those losses, Ray Dalio expands his short position in European stocks as he believes that this pandemic can potentially tip global economy into a recession and possibly into a depression, as Euro Stoxx 50 index drastically dropping. Euro Stoxx 50 index is very similar to United States S&P 500 index, but instead of tracking 500 largest companies in the United States, it tracks 50 blue chip stocks in 11 European countries such as Italy, France, Germany, Spain, and many others. Currently, this index is trading around $2,400 a share, and 4 weeks ago, it was trading at the price of $3,900. That's almost 40% decline in such a small period of time. They dropped by 10% more than S&P 500. When it will drop to $2,000 a share, it will be on the same level where it was during the 2000s dot-com bubble and 2008 global financial crisis. Ray Dalio is currently betting $14 billion on European stocks, majority of his short positions located in France and Germany. In France, he has about $5.2 billion and in Germany, $4.8 billion short positions respectively. I'm quite surprised that in Italy he has less than $1 billion in shorts, as the entire country is in lockdown. Ray Dalio manages around $160 billion under management. $14 billion bet is less than 10% of his total portfolio. It's not that clear if this is his only bet. I am assuming he has number of different short bets worldwide, just like he recently covered his $1.5 billion bet of put options on S&P 500. On Monday, Ray Dalio said in a LinkedIn post that Federal Reserve decision to cut rates to almost zero puts the market in even more dangerous position. Long-term interest rates hitting the hard zero floor means that virtually all asset classes going down because of this position effect of the interest rates falling won't exist. I agreed with what he had to say. And who's going to suffer the most? European countries. But you may ask why. Because in Europe interest rates is already in zero and in some countries is negative. So what those European countries actually did, they bought large quantity of US bonds, where they were able to extract some positive yield. And now, since US went to 0% interest rates, I'm not surprised that European stocks got hit much harder despite this pandemic. On March 19, Ray Dalio was interviewed by CNBC. Let's take a close look what exactly he had to say.
I want to emphasize that we're in an economic downturn, a crisis that has a health part of it, has an economic part of it, has a monetary part of it, and we're hitting zero interest rates. So what you're seeing right now, very classic, is the inability of central banks to stimulate monetary policy in the way that is normal. In other words, in a regular cycle, they push the button, poof, and they stimulate and give people credit. And people with money and credit, they go out and spend more and they pick up the economy. But the capacity to do that when you hit the zero interest rate floor and when monetization doesn't work anymore, because pushing interest rates will not push bond yields down. Buying bonds will not push bond yields down. And then you have the loss of interest rate declines, the loss of getting money to the people who need it through quantitative easing. When that doesn't work anymore, then you are in the position now. So very classically, right here now, what you have is the federal government, which does not have the capacity to make money and credit. You have them coming in and spending a lot more money, not nearly enough money. We estimate right now that the corporate losses would be in the vicinity of, in the U.S., about $4 trillion. Globally, probably about $12 trillion.
Say that again, $4 trillion in the United States, $12 trillion globally. That's with a T?
That's right. So the size, there'll be big losses. And those are corporations. There'll also be individuals who have very big losses. And individuals who can't afford the shock that they're going to have. So there's a need for the government to spend more money, a lot more money. And where do they get
how much more money, Ray?
Well, we're going to have to, it depends on whether it's provided as loan guarantees or credits or something along those lines. I would say somewhere in the vicinity of $1.5 trillion to $2 trillion is a minimum. And what that means, where does the government get the money? Okay, who are the lenders now? Everybody's almost hit. And so the way this works, the way it's worked in history, is that they have to get the money from the Federal Reserve. So you are in a moment in time right now, you're seeing it play out. It's played out in history. It's played out in the 1930s, in which you're now seeing we're going to spend a lot of money on these programs. That means you're going to have to sell a lot of bonds. Okay, who is going to buy those bonds? A lot of people are going to be broke. A lot of, if you look at the condition of pension funds or other endowments, so where's that money going to come from? As in history, that money will have to come from the Federal Reserve. So you see it right now. When you see a big program being announced, like that program, you see the bond yields back up. Now, if the central bank does not then go in there and buy those bonds, and the central bank at this point is in a dilemma. And what should happen with interest rates and so on? If those rates back up because the supply-demand imbalance is not good, then you're going to have the next wave of the crisis, because interest rates rising will cause asset prices to go down more again. And they also will mean that debt squeezes will be a problem, and also credit spreads would widen. This is just mechanics.
As he emphasized that we are in economic downturn, and since central banks cut rates to zero so fast and so irresponsibly, what they actually did is they just handicapped our economy. As I keep repeating myself over and over again, we have no monetary stimulants. In addition to that, he estimated that US corporate losses will be at $4 trillion, while globally it will be close to $12 trillion. And those are only corporate losses. But what about small businesses and individual losses? Where are we going to get those money? Let me take a wild guess. Fed just going to print those money until they implode US dollar. Also, there was another interview clip based on very important topic, that is paradigm shift. We have to keep very close attention to this change if you want to stay ahead of this curve. Let's take a look what Ray Dalio had to say.
What I mean by paradigm shift is there are environments that have certain characteristics and they end. And then you have environments that have other characteristics and they end, right? So the 30s was one way, the 40s was another, the 50s, non-inflationary growth, the 60s, the breakdown of the monetary system, the 70s, the acceleration of inflation, the 80s, the disinflationary growth, the 90s leading up to the bubble. Every decade has, not necessarily a decade, but these periods. And then what happens in those periods is that people get so used to those periods that the ironic thing is that kind of late in those periods, the markets are discounting those periods to continue, even though at the beginning of them they don't. So the markets sort of go from not expecting it to then at the end of the period sort of discounting it, and then you have the big adjustment in the markets to whatever that new paradigm is.
What are we shifting from and what are we shifting to, and why do you think the shift is occurring?
Shifts occur because the forces behind them cannot be continued, right? And yet they're extrapolated, right? So I think when we think about this particular paradigm shift, I think about 2008 and 9, creating an environment in which there was a great easing of monetary policy with the lowering of interest rates. And then it was an ideal environment for capitalism because we had then corporate tax cuts. We had big margin expansions. As a result of the big margin expansions, it was very good for those who owned stocks and less good for those who were the workers. We had then a big increase in the wealth gap. Consistent with the monetary policy, we had quantitative easing that had the effect of buying a lot of financial assets. And those buying of financial assets drove the financial assets up, drove future returns down. It created a situation in which we have a wash with capital, right? All the investors have just so much money, and they're chasing those investments, which is driving future returns down. Each one of those things can't be extrapolated, right? We're not going to have the same magnitude of interest rate cuts. We're not going to have another round of corporate tax cuts. We're not going to likely have the same kind of margin expansion. And so we're now at a point where we can pretty much be sure that those things are not going to be extrapolated, okay? And so then we're approaching a paradigm shift.
Paradigm shift is happening right now. Most of the wealth that is being lost from the stock market and crude oil will go somewhere eventually. Wealth cannot be destroyed, but it can be transferred. First, people run into liquidation, which means they sell financial assets and they run into US dollar. But then that cash shifting elsewhere. I believe as our world becomes more technological and more digital, we will see large influx of US dollar coming into Bitcoin and other cryptocurrencies. I think precious metals will benefit as well, but I'm definitely not going to be the one who will be buying those precious metals. I will leave that job for old people such as Peter Schiff and Mike Maloney. Let me know what do you guys think about Ray Dalio bet against European stocks. Leave your thoughts in the comment section below, hit that like button and subscribe.